Today I want to talk about how most of the illegal shorts and FTDs are actually hidden overseas, and how these liabilities still exist and have created a huge black hole of risk in the US financial system. So stay tuned and let's make some money. Also, in terms of those fast-moving momentum news plays, I'm currently setting up a way to alert you guys faster, more reliably, more regularly, and with phone alerts. And that system should be going live this coming Monday. And now I'll dive straight in with the key information. So, as Citadel tweeted, he said under FINRA Rule 4560, firms are not required to report short interest positions held overseas at separate legal entities. And he clarified saying subsidiaries are separate legal entities. So all of the hundreds of Citadel and Goldman Sachs Cayman subsidiaries and European subsidiaries are exempt from reporting short positions. So you can see from the FINRA website, question 8 asks, is a firm required to report short interest positions that are held overseas at separate legal entities and are therefore not reflected on the firm's books and records? And the answer follows saying no, FINRA member firms are only required to report short positions that are held in each individual firm or customer account, including the account of a broker-dealer, that are reflected in the firm's books and records in the US, as described in Rule 4560. There's also an extract from the SEC website that says, I was shocked to discover that not one financial regulator abroad, or at least one that will admit to it and disclose under the Freedom of Information Act request, is monitoring US issued securities' FTDs on an individual company basis. Saying because the SEC and FINRA have naively or purposefully absconded their duty to protect US investors and markets by allowing Regulation S exempted securities to be traded with no protections against synthetic shorting or FTDs. So in Europe, European hedge funds have to report FTDs on European stocks, but those European hedge funds don't have to report FTDs on American stocks. Because the European regulators are only interested in European stocks, and US regulators are only interested in US hedge funds operating in the US, trading US stocks. But there's this massive blind spot for European hedge funds trading and failing to deliver on US stocks operating from Europe. And that's the same not just with Europe, but with the UK, with the Cayman Islands, and with pretty much every other country around the world that isn't specifically inside the US. And as Susan Trimbath has tweeted, she said this is what's created the black hole at the centre of the US financial system.
From the outside, the entire structure of a basic black hole can be described as a singularity surrounded by an event horizon. Nothing escapes the event horizon. It all gets squozen into the DTCC obligations warehouse. Investors cannot see inside the black hole. The formation obliterates all information about what collapsed to form it. The fails to deliver continue to collapse under their own weight, forming an infinitely squozen point, a place of zero volume and infinite density, where space-time ceases to exist. The laws of supply and demand as we know them break down.
So this, I think, is a perfect example of what happened to AMC's FTDs after the QSIP change. Those FTDs were hidden overseas and sent to the obligation warehouse. Those FTDs didn't cease to exist. Those FTDs weren't cancelled. They're just held elsewhere in this infinitely dense area. There's no volume because these FTDs and old QSIPs aren't traded anymore, but those liabilities still exist. It's an area of zero volume, zero trading, but infinitely dense liabilities. This obligation warehouse can be seen on the balance sheet of tons of hedge funds and banks around the US. In that figure on the balance sheet or that line stated security sold but not yet purchased. So those liabilities absolutely do still exist and have created this giant black hole at the centre of the US financial system. Someone replied saying, is that obligation warehouse where the FTDs go to die? And Susan Trimbath replied saying, not exactly, because it's where the FTDs still are. Those FTDs and those liabilities still exist, they're just in a place where there's no volume and no trading, hidden overseas and in the obligation warehouse. But those liabilities will still fall due, especially if the related stock's price continues to increase. And she said it will cause a stock market implosion indeed. The formation of the black hole obliterates info about what went in. FTDs collapse under their own weight, forming a point of zero volume and zero trading, but of infinite risk. And that's why Gary Gensler is continually concerned about the hedge funds receiving their repo financing in the non-centrally cleared market. There's all of these hedge funds, institutions, banks and market makers that are doing business away from the DTCC systems, going through the non-centrally cleared markets or over the counter, over the telephone, over WhatsApp or over email. This is because when you're doing business in secret, you don't necessarily have to follow SEC rules or maintain margin collateral or meet margin requirements. Because haircuts and initial margin requirements are not necessarily applied, and these hedge funds and market makers and institutions may be failing to meet margin requirements, and saying this will create greater risk in times of stress. And that's why Roy has tweeted saying, "I don't like that everyone is crowding and taking safe haven into the magnificent 7 stocks of Apple, Microsoft, Google, Nvidia, Netflix, Tesla, and Amazon." And he said, "This is the most crowded trade I've seen in my career over 35 years. He said it will work until it won't. And that's why, as I said in my previous video yesterday, when these stocks do start to crash, inevitably, short selling is likely to be banned because politicians and their net worths will be at risk. And if politicians all of a sudden see their net worth at risk, they'll ban short selling quicker than you can imagine. It won't just be short selling on banks, because the majority of these politicians actually have their net worths again in these magnificent 7 stocks and other tech stocks and other S&P 500 companies. The only way for these politicians to avoid losing their net worths in the market crash is to ban short selling US stock market wide. And that's why it may also be worth paying very close attention to Bank of America. 741 Trey tweeted saying, "Interesting timing. Bank of America is closing their stock loan hedge account effective tomorrow." Now, I'm not sure what specific impact that has for Bank of America, whether they're de-risking or they're going to stop hedging on securities lending. But what I do know is that Bank of America right now is in big trouble. You will know in some of my previous videos, I've spoken about BofA's massive unrealized losses that have now increased to $130 billion. And remember that Bank of America is the prime broker for 87.2% of Citadel's net derivative assets. Bank of America holds that collateral, and if Bank of America is in trouble, they will margin call Citadel to save their own skin. And Charles Payne is at it once again by exposing the amount of people or the amount of politicians that have been paid off by FTX and by Citadel, saying the number of politicians that haven't been paid off is a very short list. Also guys, I wanted to quickly recap my fast moving momentum news play of the day, which today was BTAI, or BioXcel Therapeutics. I said if we see this pre-market high of $3.48 breaking, BTAI could very easily run up to and above that resistance at $5 per share. Unfortunately today the trade wasn't triggered because that pre-market high still hasn't broken. That's why it's important to always wait for confirmation and to not enter a trade until you get that confirmation. Don't enter a trade prematurely expecting that pre-market high to break, and even if it does break for a singular minute, that's still not really confirmation. That's just a fake out. Over the last few days, we've had 10, 20 and 90% plus winners. Today, the trade didn't trigger, and that's all right. The main aim of this game is to maximize your profits and minimize your losses, or in today's instance, take zero loss whatsoever. And as I said at the start of the video, I'm working on a way to bring these fast moving momentum news play alerts to you guys faster and more reliably. And that system should go live on Monday. So be sure to wait and anticipate that announcement in my Monday's video. I'm also fully fledging out this system to include educational videos so you guys can learn how to maximize your profits and minimize your losses. There's also going to be watch lists, earnings calendars, IPO watch lists, and much, much more. But guys, be sure to let me know what you think down in the comments below. And as always, guys, be sure to ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.